Mark Matthews, Head of Asia Research at Bank Julius Baer, is also joining us right now on the show. Mark, thanks very much for taking out the time. Let's talk a little bit more about what's happening across the globe. We've seen Brexit and the excitement around striking a deal, but then that falling flat on the back of no parliamentary support. Trade talks, it's just so difficult to gauge what's happening because, one day there are talks of a trade deal being negotiated, the next day, some other requirements come about and that falls flat as well. So it's a little difficult to gauge as to what's happening globally, but the implications for Asia as a whole and the emerging market back.
Well, starting from the top, Brexit, I think the most likely outcome is the delay and then probably a snap election in Britain. So therefore no immediate outcome, but generally a positive one. We are moving toward a soft as opposed to a hard Brexit. So I think the pound was down about 0.6% last night, but it's not a disaster. So I think as messy as British politics in most democracies are messy, it is moving toward a more favorable conclusion. And then on the trade side, I think there's also room for optimism because I think the deal that the U.S. and China agreed upon a few weeks ago is a strong indicator that both of them want to take a truce and a timeout. And so I think we should be optimistic that when Xi and Trump meet in Chile, they will sign something. In fact, I noticed this morning that China has started purchasing U.S. soybeans for the first time in many months. So that's a sign of moving in the right direction. But what's really been the biggest headwind for Asian markets has nothing to do with any of that. It's simply the strength of the U.S. economy and the technology sector there sucking up the capital away from the rest of the world, including Asia. And that's been the trend really since 2011, I would say. And I don't see it particularly ending, or should I say I don't see an inflection point. And therefore, money will probably stay away from emerging markets. And the key thing to watch would be the dollar. When the dollar trend changes, that's when you can expect a more meaningful amount of money to come back into emerging markets, and including Asia.
Where does India stand amongst all of this? So we've seen foreign investors slowly but steadily starting to put in money, at least in the last month or so. While the overall net figure is still a big negative for the month of October, there have been a few days where FII buying has happened. Is the thought process any different than it was a few months ago, or it's still probably China first in terms of whether or not they have to make any investments into the equity markets, and then the rest of the pack?
It's China first simply because of China's size, and I can't remember off the top of my head, but if I said China is 3 times the size of the Indian stock market, I think I'd still be too low. It's a much bigger market, and therefore it'll always attract attention, and because it's providing 30% of world GDP growth, people watch it much more closely. But I would say the mood has changed to a more positive one on India over the last month, and it's really a response to the government clearly becoming much more proactive. The corporate tax cuts were one thing, but the finance minister has held many meetings, or I should say press conferences, etc., to show that the government is committed to reform and trying to stimulate the economy across a whole variety of sectors, from automotive to financial. And so I think that 180-degree turn on the part of the government in the last month or so has inspired foreign funds to return to India.
What did you make out of the IMF growth projections? They've brought India's growth projections down to 6.1. This morning we saw Asia forecast for growth also being brought down.
I think 6.1 is probably about right if you're talking about full-year GDP. I think there are a bunch of reasons to believe we are at a bottom in the India economy, and now the monsoon was delayed, but then you had good rains during the summer, so the rabi crop should be good next year. Corporate tax cuts, interest rate cuts. and exports in electronics very strong. There's a whole bunch of little things, and when you put them all together, I think we will, even if it's not showing up yet in the high-frequency data, end the year at about 6% year-on-year growth. And that's a good rate of growth. That's nothing to be ashamed of. It's not 8% like it was 2 years ago, but relative to the rest of the world, 6% is a great number.
Mark, good morning. The skeptics out there, and great having you, by the way, but the skeptics out there, when told about this 6%, nothing to sniff at, say that if you look at the per capita growth from an investor's perspective, that India adds at 6% is what, $180, and that's not great for the kind of consumption growth that the country should ideally show, and therefore investors don't come in lock, stock, barrel, but take a measured approach. Would that be a fair assessment, or do you differ?
Well, I mean, yes, if you wanted to do it on a per capita basis, obviously everything looks much smaller than developed countries or China. But I would also, play the devil's advocate and just say that that shows you the potential for a lot of growth if they can get things right. And I think they're starting to get things right. And the consumer definitely has been a disappointing feature of the economy. And I think that can be traced indirectly to demonetization and GST in part because it's held back employment in the small and medium-sized enterprises, and then much more directly, of course, to the NBFCs, which were doing a lot of consumer goods, cars and houses and white goods, and of course the liquidity crunch in the NBFCs has stopped all that. But I think that private banks can pick up a lot of that slack, and I think if you add it all together, we are at a low here. I don't know if I'd call it an inflection point because we're not predicting a V-shaped recovery, but I do think things will continue to get better over the next 6 to 12 months.
Okay. Mark, just wondering, a lot of people who are global investors, and because you yourself are one and you would have spoken to so many, have always maintained that investors don't come to India for infrastructure investments. They come to India for the kind of returns that consumers would give. Now, a large portion of consumer exposure could be taken via financiers as well, which over the last 12 months have been under a bit of issue because most of the financial names are doing consumer financing. Do you believe the higher valuations are a deterrent, or the long runway of growth would still attract large pools of foreign capital into the Indian financial space?
Well, for sure, valuations matter, and you're absolutely right that you have to pay up to buy private sector banks, but I think it's worth it because I think that the PSUs, which are something like 65% of the entire banking system, we know they're just being given enough capital to survive, but not to grow by the government, and we know that the NBFCs are essentially paralyzed by this liquidity issue. So there is a time to shine for the private banks, which I think is now, and several of them have new management and their NPAs have largely been put behind them. So as is the case in most parts of the world, you have to pay for the good stuff, and I don't think it's any different with the private banks, and they would be one of our top picks, actually. I think they should be owned.
And which brings me to my second question, Mark. The government is on a divestment overdrive, seemingly. Do you think foreign capital will come in for the PSU assets in India, a strategic stake?
Well, it depends which ones. I'd have to say, not that I know a lot about them, but most of them probably aren't that interesting. They're probably not making profits. Maybe they could be. But the big ones that we know are good assets, like Bharat Petroleum, for example, I do think there will be very strong interest in those, for sure.
All right. Mark, while we were on the topic of equities as an asset class, I want to get your opinion on gold as an asset class, because so far this year, we've really seen the outperformance coming in from the yellow metal. Is that likely to continue to do what it's doing? We've seen central banks loading up on gold. We've seen even speculative trades and long positions being taken in the CFTC market. But aside from that, just the fact that you've seen this big price uptick, is that likely to sustain?
Well, clearly the momentum has been broken. It was a wonderful trade up until about, I don't know, a month or two ago. And it's a good thing that it took a break too, because whenever something is parabolic, a parabola looks like this and then it looks like that. So it's good that gold is pausing. I do think you're right to mention the speculative positions in the futures market. They are still very high. I think the weaker holders need to get washed out, and you can also look at the ETF holdings, which are very, very high, or at least the inflows into gold ETFs. And I'd want to see a bit of a washout into those, but I'd be a buyer of gold at about 1440, and I still think it'll finish the year at new highs. Well, not new highs, but highs for the year, put it that way. Because interest rates are low everywhere in the world, and we do have a lot of political issues in the world, the election in the U.S. coming up, et cetera, et cetera. The U.S.-China, as much as it's a trade truce, we all know that these are two superpowers bumping up against each other. I think it makes sense to have about 5 to 7% of a portfolio in gold.
Right, just balancing out the risk then. What's your sense with regards to the U.S. equity markets, and do you see any hiccups in this move that we've seen, where the S&P and the Dow, both of them are trying to, both the indices have been holding on to those record high levels? Do you feel that there is, a speed bump that could have a more amplified effect in markets like Asia and the other emerging markets?
Well, I think that the bull market will continue, and there's probably three reasons. The first is I believe Donald Trump will be reelected next year. Moody's recently issued a report based on three different factors showing that's a high degree of likelihood. And we know that he's pro-business. The second thing is that I think interest rates are likely to stay very low around the world. They might not drop a lot more, but if you look back at long-term charts, interest rates, they tend to need to bottom for a very long time before moving up again. And the third point is simply, yes, this recovery has lasted over a decade in the United States, but the pace of growth is about half of what it was during the second longest recovery on record, which happened to be from 1991 to 2000. And so there's actually a lot more growth that still can happen in that economy. And I put that all together, and I think actually, yeah, the bull market can continue in the United States.
Right, Mark. And on that positive note, it was great chatting with you. Thank you so very much for joining us with your thoughts.
Thank you.